Hi, welcome to video lecture Shivananda Sharma Memorial RV College and ISR Initiative. SSMRV College, one of the premier institutes run by the prestigious RV group of institutions, has come up with a unique initiative to engage students at the time of this unforeseen medical emergency caused by corona outbreak. As a socially responsible institution, we would like to connect academically with students to make good the losses caused. In this connection, I, Pallavi of Department BBA, is posting a video on the subject stock in commodity markets and the topic trading in commodity markets. Please watch the video till the end and like, share with your peer groups and subscribe to our YouTube channel. Thank you. Students, this is the last chapter as per your syllabus and it is a very small and easy chapter. So now let's start. What is commodity? I have already taught you in the previous video lecture. So commodity is nothing but the metals or agricultural produce or any other items which is traded in the market. So commodity trading is the market activity. It links the producers of the commodities effectively with their commercial consumers. That means only in a market you can meet both the consumers as well as the marketers, right? So it acts as a place where both the people, producers and the consumers can meet. So commodity trading mainly takes place in the commodity markets where raw and primary products are usually exchanged. So you all know a market is a place where exchange happens, exchange of goods, buying and selling. Right? So commodity trading is nothing but a marketing activity or a market activity where the producers and the consumers come or meet together to exchange the products. So the next topic is, why should you trade in commodities? So the first point here is big market, diverse opportunities. So India is a country with a huge population and it has an economy based on agriculture, precious metals and some base metals. So trading in these commodities provides very beneficial opportunities, market opportunities for wider section of participants who have diverse interests. Okay, participants may be the investors, hedgers, traders, manufacturers, importers, exporters, like this. So that's why it has a diverse opportunities and it's a very big market. And the second point is get to the store. Students, commodity trading has been a breakthrough in expanding the investment from investing in a metal company to trading in metal itself. In the previous video lectures also I was just talking about this. When you can invest or trade in metal itself, when you can trade in metal itself, why would you invest in metal? Right? So that's the opportunity you get in a commodity market. And the third point is huge potential. Commodity exchanges see a tremendous daily turnover of more than I don't know the exact figure. It may be some crores, some thousand crores. For example, 20,000 crores, or it may be more than that. Okay, so this gives a huge potential to market participants to make profits. It may be any kind of participants, as I told you while explaining the first points, like investors, hedgers, exporters, importers, anybody. And the next point is exploitable fundamental. See, the fundamental for commodity trading is very simple. It is nothing but price is a function of demand and supply. So hedging, see, you hedge your products to cover the risk, right? So it helps you by taking appropriate contract. So this makes things really easy to understand and exploit the fundamental things in commodities, because there are various metals where you can trade in. And the last point is portfolio diversifier. Commodity futures derive their prices from the underlying commodity and commodity prices cannot become zero, right? So commodity has a global presence and their prices move with global economies, and hence it is a good portfolio diversifier, and that's why trading in commodities gives a very good benefit for all types of participants. And the next topic is commodity trading markets. There are two types of markets. First one is spot market and the second one is derivatives market. So you all know what a spot market is because I've already discussed in the previous video lecture. A spot market is a market where the commodities are bought and sold for immediate delivery, right? So spot trading is any transaction where delivery either takes place immediately or within some a lag between trade and delivery due to technical constraints. It may be a 2 or 3 days. Okay. So what is derivative market now? So derivative market is various financial instruments having commodities as underlying are traded on the exchanges. Okay, so derivatives has seen that traditionally in India people have hedged their risk with gold and silver because it's always good to be on a safer side. So guys, there are different types of commodity derivative contracts. Okay, forward contracts, future contracts and hedging. So now let's discuss what is forward contracts. A forward contract is an agreement between two parties to exchange at some fixed future date a given quantity of a commodity for a price defined today. So today you are defining the price, but you are exchanging on a certain future date, and the fixed price today is known as the forward price. Okay. And the next one is futures contract. A futures contract has the same general features as a forward contract, but is standardized, and it is very much standardized and transacted to a future exchange. A forward contract is between a friend, you and me. It is not too standardized or not too format procedured way, but here it is traded on an exchange, so it is more safer than forward contract. So commodity future is a derivative instrument for the future delivery of a commodity on a fixed date at a particular price. So the next topic is hedging. We have discussed quite a lot of times about hedging. So it is an activity where you can cover the risk of fluctuating prices in the market. Okay, it's a common practice of farming cooperatives insures against a poor harvest by purchasing futures contract in some commodity or in the same commodity. So these are the different commodity trading markets. Students, the next topic is trading and settlement process in commodity markets. So there are three processes or three steps. The first one is order matching mechanism, and the second one is trade clearing mechanism, and the third one is clearing and settlement. So first we will discuss about order matching mechanism. Okay, see, traders place their order through a registered commodity broker of a commodity exchange. In order matching mechanism, he has to identify a broker, a registered commodity broker, and then he has to place an order, and later the trader's order is entered by the authorized dealer into the online terminal. He will enter it into the online terminal, and then the order finds match automatically through the online channel. So randomly or automatically the order is matched. Okay, and if it doesn't find a match at that very moment, then it gets stored in the online order book until and unless the similar and opposite order matches it. Okay, that's why it is called order matching mechanism. And then when the two and similar and opposite orders match, then a trade is said to be complete. Okay, and the next process is trade clearing mechanism. So in trade clearing mechanism, there will be a timely settlement and the registration of the trade, and there will be consequent follow up, okay, of the settlement, and the delivery of the commodity to the concerned buyer and simultaneous payment to the seller will happen, and then the settlement of funds in non-delivery cases will happen through this clearing mechanism. Okay. And the last process under commodity markets is clearing and settlement. Clearing and settlement of commodities in the commodity trading system commences only after the end of trading hours and on the expiry date of the contract. Correct. So the processing of delivery matches some different considerations. So the considerations are maybe the location of the order, available warehouse capacity, total quantity of commodities that have already been deposited and given to dematerialization of the securities. So these are the different matches which considers for the process of delivery. And the next topic is types of settlement. So there are only two types of settlement: daily settlement and final settlement. Daily settlement is done at the end of each trading day, and final settlement is done on the date of the expiry date of the contract. And daily settlement is based on daily settlement prices per that day's price. Okay, the contract or the agreement will get settled. And final settlement is based on the final settlement price or the due date of the contract. Okay, and the last difference is daily settlement takes into account all trades and all open positions which are marked to mark. Okay, and final settlement takes into account only trades not closed till contract inquiry. Suppose my contract end date is May 29, so it will end on May 29th only. But whereas in daily settlement, it is based on that day's transaction or that day's agreement, which are open positions. Okay. And the last topic of this chapter is steps for trading in commodity futures. So there are three different steps. So the first step or the step one is choosing a broker. So as you all know, you need a broker when you have to deal in a commodity market and a futures market. First step is choosing a broker. So you have to choose a broker based on different competencies. So it may be the competitive edge provided by the broker, broker's knowledge, credibility of the broker, experience of the broker, or it may also be the net worth of the broker and the quality of broker in trading platforms. So these are the different areas where you decide on which broker you will be choosing for your contract or trade. And step 2 is depositing the margin. All of you would have some funds or savings where you would want to invest or trade in the commodity market, right? So the second step here is to begin the trading, the investor should deposit a margin with the broker. So margin requirements are of two types, okay, initial margin and maintenance margin. So these margin requires various commodities and exchanges, but typically the initial margin will range from 5 to 10% of the contract value, and the maintenance margin is usually lower than the initial margin. Okay, so this is how the trade begins. And there is one benefit for the investor, because he has the option to withdraw any extra funds from his margin account if his position generates a gain. So that's the benefit for the investor. So that's about step 2. And then step 3 is access to information and a trading plan. So every investor would like to know about the information where he is trading or which commodity he is trading and what would be his trading plan, right? So first of all, he needs an access to prevailing prices and the market information that can help predict price movements. And also the brokers provide research and analysis to their clients. There are some other informations like financial dailies and specialized magazines on commodities and the internet. Only if an investor gets to know about these information, he can know how well he is able to gain through the trade, right? So further, an investor requires a trading plan. So trading plan can be developed in consultation with the broker, because broker will have more experience dealing with various clients, and he also has knowledge about the market conditions and how the prices fluctuates. So these are the 3 steps for trading in commodity futures. This is a very small and an easy chapter. So I hope you guys understood. Any doubts, please let me know. So guys, thank you for watching, and please don't forget to like, share with your peer groups and subscribe to your YouTube channel. Thank you.